Hi, this is the Excel ratio analysis from chapter 14. So I wanted to give you an Excel file where you can see, here's an example of a balance sheet for the past 5 years. And in the balance sheet, you can see that we have blue and black colored numbers. So the blue numbers are just stagnant numbers, and the black are formulas. So you can see, if you review, you can see how the current assets, there's a summation here for the current assets and the non-current assets, which are sometimes called long-term assets. And then we have the current liabilities, long-term liabilities, and then total shareholders' equity. And we have this check here. So we're making sure that the assets, the total assets, minus the total shareholders and liabilities equals zero, because they should balance. So here's a balance sheet that you can review with the formulas in it, and of course also an income statement. So from revenues, cost of goods sold, gross profit, SG&A, research development, depreciation, interest expense, taxes, net income. And then finally the cash flow, example of a cash flow statement. So you can see how these are calculated for operating, investing, and financing activities, and then the change in cash flow at year end. And then finally, the information from the financial statements, you can go down here and you can see how the formulas are here for how each of the ratios are calculated. So for example, this is sometimes known as EBIT, or operating profit ratio, net profit ratio. We have a tax ratio. So some of these ratios are extra. I put in that aren't covered in the book, but this will tell us how much we pay in taxes in relationship. If we go up to E48, total taxes in relationship to the before income taxes. So what percentage of income we're paying in taxes. The interest coverage ratio. And then we have, this is the percentage, if we look again to E37, total revenues as related to what's the percentage of SG&A to total revenues, and how is it changing over time. So we see it moving in time here. We can go down here and we have our quick ratio, our current ratio, total asset turnover, net asset turnover, number of periods in the day, so 365. Some days are leap years and may have an extra period. And then we have our efficiency ratios, inventory days, inventory turnover ratio, accounts payable ratio, and days, accounts payable ratio, and then accounts payable days. This would be the PP&E is property, plant, and equipment, sometimes called a fixed ratio, turnover ratio. And then we have our leverage ratios here. We can expand these. And our total assets to equity, our asset test, this is the without inventory, and return on assets and return on equity. So these are just a number of useful ratios to look at. And this is a time series analysis, so we can see how they're changing over time. Now, later in the chapter, it talks about the DuPont Method. So this pyramid analysis is really the DuPont Method, where we look at basically return on equity is our top ratio. So this is the return on the shareholders' equity we want to look at. And we want to, in this, so these numbers you can see are brought up from this row G127. So if we go to 127, you see here are the ratios coming into play, and they're just hard coded to be moved down here. So then we could break out, I think this is a little smaller. So we can break this out. Return on equity is going to be a combination of net profit ratio, total assets to equity, and total asset turnover. So these three components are going to make up the return on equity. So if you're looking at just focusing on the net profit ratio, we could see that this is going to be reflected in this sub-pyramid here, where we could see capital structure, tax ratio, EBIT, gross profit, SG&A, so we can kind of look at everything influencing the net profits, and then we can look at everything influencing the total asset turnover on the other side. So the idea is to look through the years and see which ones are improving, which ones are not improving, to help contribute. Why did we go from return on equity from 15 to 32%? So this would sort of be the flow or the map that we could use to look at what's changed that helped propel our return on equity. Was it profits going up? Was it the mix of assets and related to equity, which would be here total assets to equity? So which is the main contributor that's changed? So we see up top here that the net profit ratio has gone up and then down, and then our total assets to equity have done something similar. So this would really just be a roadmap to kind of try to identify the key ratios that affected the change in the return on equity, which is basically the DuPont method. Okay, so just wanted to give you in spreadsheet form how all these ratios are calculated, and then how show you directly how they're related to the financial statements with formulas, so you could see where the formulas, the inputs for each of the formulas are coming from. Okay, so this would be a basic trend analysis here. Now I want to also show you a industry analysis. So here we have an industry analysis, which if we look at this, we have these are various fast food companies: Chipotle Mexican Grill, McDonald's, Wendy's, Yum, Starbucks, Dunkin' Donuts. I think this is Burger King, Popeyes. And then for an industry, we bring in, this would be 2019, we bring in the financial statement, the relevant inputs from the financial statements. And then we basically just create an average, which is going to be an average of 2, 3, 4, 5, 6, 7, the 7 companies involved in this industry analysis. And then we could lay out the financial ratios. We have the industry here, and then we could have each of, let me see, actually let me just change this. Okay, so we have each of the company's individual ratios in the 5 ratio categories: liquidity, asset management, debt management, profitability, and market value. And then we have the industry average. So we could see which companies are above the industry, which companies are below the industry. And you could actually, you could do a conditional formatting on this, where you can say, is it above or below the industry average, to kind of get an idea of how well the company's doing. And you can also take this particular file has the 2019, 2018 industry, and then each of the individual companies. This is their financial statements for McDonald's for the past 6 years. So this is how we can do, this would be a trend analysis over the last 6 years for each individual company and then the industry. So if we refer back to Chapter 13, if we felt like the fast food industry would be doing well, then we would want to look at which companies in the fast food industry seem to be doing the best, and we can, so either look at an industry analysis to see which of the companies in the industry are outperforming the industry averages, and then look at even at the individuals to see a trend analysis to see how they're doing. And we can even do a year-over-year industry analysis where we look at what's the percent change for each of the companies from 2018 to 2019, including the percent change on their ratios. Okay. All right, so that's the spreadsheet file for today. Just want to kind of give you a couple examples of how you can use the financial ratios, whether in an industry or a trend analysis, to help analyze a company's performance. Thank you and take care.